Have you ever felt like something is just off with the financial system? Like a storm is coming but no one is talking about it? Let me tell you this. The collapse of regional banks in 2023, that was just the beginning. The truth is, what we're living through right now is just the start of a much bigger crisis. And if you're not paying attention, you're about to be caught off guard. In just 6 weeks, we will enter stage 3 of this banking collapse. Here's the kicker. It's not just about banks failing. It's about consolidation. It's about your bank disappearing and you not having a choice about it. What happened in Cyprus, where people's deposits were taken to save failing banks, could be coming to the U.S. But before we get there, let's break this down. The first stage of this 5-stage collapse, regional stress. In March 2023, Silicon Valley Bank, Signature Bank, and First Republic Bank all collapsed. These weren't just small-time players. These were top 30 banks in America. And they failed in a matter of days. It was like a warning shot that nobody heard. But the media? They called it contained. The Fed said, it's under control. But they were wrong. We're still in stage 2, and it's worse than they're letting on. Banks are still in trouble. Regional banks are struggling with bad loans, $1.5 trillion worth of commercial real estate loans that need refinancing. And let me tell you, that's a ticking time bomb. You may think you're safe because your bank isn't one of those big players. But let me make it clear, you're not safe. By January 2026, stage 3 begins. The government will force banks to merge. Small, struggling banks will be swallowed up by mega banks like JP Morgan and Bank of America. Your account, it will just transfer, no questions asked. And that's when stage 4 hits, deposit seizures. You heard me right. Your uninsured deposits can be used to bail out these banks. In Cyprus, they took 47.5% of deposits above $100,000. And the law already exists for that to happen here. It's called the Dodd-Frank Act. Your deposits can be taken to save a failing bank. Finally, stage 5, oligopoly control. By 2030, 3 to 5 megabanks will control 70% of all deposits in the U.S. No more community banks, no more local choices, just a handful of banks making all the decisions for you. But here's the scariest part. This isn't just a theory. It's happening right now. The commercial real estate market is crashing. Banks are holding bad loans. And in 6 weeks, the first wave of forced mergers begins. By 2027, 200 to 400 banks will disappear. Let that sink in. So, what can you do? The first thing? Pay attention. The timeline is clear. This collapse is already happening. The government is already preparing to step in. And when stage 3 hits, it'll be too late to react. If you have over $250,000 in a single account, understand that the risk is real. You could lose that money if a regional bank goes under. But here's the good news. You can protect yourself. Diversify your assets. Move your money to safer investments. Be ready for what's coming, because once stage 3 begins, it moves fast. You can wait until it's too late, or you can take action now to prepare. But the question is, will you be ready? ChatGPT da noi. It's been said that history repeats itself, especially when we fail to learn from the past. If you look at the pattern of banking crises, you'll notice a recurring sequence. It happened in the United States in the 1,930 seconds, Japan in the 1,990 seconds, and Cyprus in 2013. These events followed a similar 5-stage pattern, and now we're seeing it unfold once again. Let's break this down to understand how exactly the banking system is on the brink of collapse and what it means for you. Stage 1. Regional stress. When Silicon Valley Bank, SVB, Signature Bank, and First Republic Bank failed, it wasn't just a fluke. These banks were not small-time players. SVB was the 16th largest bank in the country. Signature Bank was the 29th largest. When they collapsed, the initial reaction was panic, but the media quickly declared the situation as contained. In reality, the collapse of these banks was a symptom of something much deeper. They weren't just caught off guard by rising interest rates. They were exposed to sectors of the economy that were already in trouble, like commercial real estate, technology investments, and startups. And this is where things get tricky. Regional banks are heavily exposed to commercial real estate, which, as we know, is facing a massive crisis right now. There's a $1.5 trillion bubble of commercial real estate loans that need to be refinanced between 2025 and 2027. The interest rates on these loans have tripled since they were first issued, and the properties that these loans were taken out against, they're losing value rapidly. Office buildings that were once worth $10 million are now worth only $5 million. The math just doesn't add up. When the inevitable defaults start happening, it's going to send shockwaves throughout the economy. And what happens to these struggling regional banks when their portfolios implode? Stage 2. Emergency measures. The Federal Reserve and the government are already stepping in with emergency support programs, like the Bank Term Funding Program, BTFP. This is designed to inject liquidity into banks that are struggling, allowing them to borrow at favorable terms. But this is just a temporary fix. It's not solving the root problem, which is a severely weakened banking system. Right now, we're in stage 2 of this crisis. The BTFP has been operating since March 2023 and is set to expire in March 2024. But banks are still holding on to bad loans. They're still trying to keep their heads above water. The Federal Reserve is attempting to create the illusion of stability, but the problems are getting worse, not better. The reality is that the commercial real estate sector is deteriorating faster than anyone anticipated. Office vacancies are skyrocketing. Retail centers are struggling. The pandemic accelerated this trend, and now it's showing up on bank balance sheets. So, while the government is trying to stabilize things, the underlying issues are still growing. Stage 3. Forced mergers. As we move into stage 3, we're going to see something even more troubling. Forced mergers. When banks fail, the government steps in to arrange deals to protect depositors and keep the banking system from falling apart. The FDIC, Federal Deposit Insurance Corporation, plays a key role in this, taking over struggling banks and forcing them into mergers with larger institutions. What happened with First Republic Bank is a preview of what's to come. The FDIC forced JP Morgan Chase to absorb First Republic's assets, agreeing to cover 80% of its losses. JP Morgan got the good assets, while the FDIC took on the bad loans. This allowed JP Morgan to expand into new markets without the usual risks associated with a takeover. By January 2026, we'll start to see the first wave of these forced mergers as regional banks face massive losses due to bad loans. The smaller players won't survive, and they'll be absorbed into megabanks. You won't have a say in it. Your local bank could just disappear overnight, and you'll wake up to find your account transferred to one of the 4 or 5 megabanks that control the U.S. financial system. Stage 4. Deposit seizures. The next phase of this crisis is even more disturbing. Deposit seizures. You might think that your deposits are safe because they're insured by the FDIC, but the reality is more complicated. Under the Dodd-Frank Act, which was passed after the 2008 financial crisis, regulators were given the power to resolve failing banks through something called a bail-in. A bail-in means that if a bank fails, it can use your deposits to recapitalize itself. Essentially, your money can be converted into equity in a failing bank. And this isn't just a hypothetical. It's happened before. In 2013, Cyprus became the first country to implement a bail-in, taking 47.5% of all deposits over 100,000 euros to save their banking system. Depositors woke up to find that their accounts had been frozen and a significant portion of their savings was simply gone. In the U.S., the legal framework for bail-ins already exists. The Dodd-Frank Act allows for your uninsured deposits, those above $250,000, to be seized and converted into bank equity. So, if your money is in a regional bank that fails, you could lose a portion of it to save the bank. Stage 5. Oligopoly control. Finally, we arrive at Stage 5. Oligopoly control. This is the end game of the banking crisis. Once the dust settles, we'll see the consolidation of the banking industry into just a handful of megabanks that control the majority of deposits and loans in the U.S. By 2030, we could have as few as 2,000 to 3,000 banks left in the country, with the top 4 or 5 institutions controlling over 70% of all deposits. That means fewer choices for consumers, fewer competitors, and more control in the hands of a few massive institutions. This consolidation will kill competition, stifle innovation, and give these megabanks even more power over the economy. They'll set the terms, determine interest rates, and control access to credit. Your ability to get a loan or open an account will be entirely dependent on the policies of these institutions. It's not just about banking, it's about control. And if you're not prepared, you'll be left at the mercy of these too-big-to-fail institutions. Now, we're entering the final stretch. If you want to protect yourself, it's time to start taking action. The first thing you need to do is recognize the pattern. This crisis is already unfolding. We're already in Stage 2. Stage 3 is just around the corner. And when it hits, it's going to happen fast. If you have deposits in a regional bank, especially if they exceed $250,000, you need to understand that your money is at risk. It may not happen tomorrow, but when stage 4 hits, it will happen quickly. And when it does, it'll be too late to react. The best way to protect yourself is to diversify your assets. Move your money out of regional banks. Invest in safer assets, like treasury bonds or gold. Make sure you're prepared for the worst, because the worst is coming. You don't have to panic, but you do need to pay attention, because when stage 3 begins, it will be too late to act. It's time to make your plan. This is just the beginning of a crisis that could reshape the banking landscape forever. We've seen it happen before, in different countries and different times. But the pattern is clear. When stage 3 hits, you'll have no choice but to watch as smaller banks are swallowed up by the mega banks. The question is, will you be prepared? You still have time to protect your financial future, but that time is running out.